Most individual investors make the same 5 mistakes. And today I'm exposing these wealth-destroying habits and giving you the exact blueprint that professional money managers use to avoid them. So stick around, because mistake number 3 is costing you money every single day without you even knowing it. So for the sake of time, let's dive right into it. So mistake number 1 is hanging on to falling stocks. Now here's a math fact that will change how you invest forever. A stock that drops 40% needs to gain 67% just to break even. So if you buy a stock at $100 and it drops to $60, that stock needs to climb 40 points or 67% to get back to your purchase price. Yet about 80% hold on to these losers while selling their winners. This is called the disposition effect. And it's an investment mistake that can cost people a lot of money. Nobel Prize winner Daniel Kahneman discovered that losses psychologically are twice as powerful as gains. This means you feel twice as bad losing 1,000 as you feel good about making 1,000. So when your stock drops, your brain kind of goes into this panic mode, and you start creating all these stories on why it'll bounce back. I see this all the time with individuals. They hold on to a stock that's down 50% for 3 years while selling maybe profitable stocks because they look expensive. It's backwards thinking, and it could destroy your wealth building potential. So here's what separates professionals from amateur investors: the stop loss secret. Professionals use stop losses religiously. If a stock drops 20% from their purchase price, they sell it automatically. No emotions, no stories, no exceptions. This single rule protects their capital and forces them to cut losses quickly. So this leads me to wealth decision principle number 1. Winners keep winning and losers keep explaining. So the fix is set up a stop loss right when you purchase a stock. Download your broker's app after this episode and set alerts for 20% drops on every position when it hits. Sell immediately and move that money to a better opportunity. You can even put a sell stop limit order in that automatically does this for you, so that you don't have to watch your portfolio constantly. Coming up next, I'll expose the most dangerous investment trap of all, and it's costing investors billions of dollars. So don't go anywhere. So mistake number 2 is falling for story stocks without profits. These companies that have these amazing narratives, maybe they're touted on different platforms like Reddit, but they have no profits. They're always 6 months away from some revolutionary product that could change everything. So I call this the Reddit test. Ask yourself, can you explain what this company actually makes money from right now? Or are you just betting on an Elon tweet or a roaring kitty on the Reddit platform? Peter Lynch, who turned $10,000 into $280,000 for investors managing the Fidelity Magellan Fund, often said, behind every stock is a company. Find out what it's doing. Know what you own and why you own it. But with story stocks, we tend to get kind of hypnotized by what the company might do instead of what it's actually doing, which is usually burning cash. I learned this lesson the hard way with a $25,000 investment of my own in a biotech company that was 6 months away from getting FDA approval for 3 straight years. The story was incredible, and they were going to cure diabetes. But the reality is they ran out of money, and I lost 80% of my investment. Now, that was before I had a process and before I had a discipline. I wasn't investing back then. I was gambling on a fairy tale. So you need to have a process if you're going to buy individual stocks, and you need to have a way to protect your money if it doesn't work out. Here's the brutal truth about story stocks. 90% of companies that go public without profits never become profitable. You're not investing in the next Amazon. You're funding someone else's expensive experiment. So before you buy any stock, apply the 12-year-old test. Can you explain this company's current business model to a 12-year-old in under 60 seconds? If you can't, you don't understand it well enough to risk your money. So this leads me to wealth decision principle number 2. Invest in profits, not promises. So the fix is never allocate more than 5% of your portfolio to unprofitable companies. Focus on businesses with consistent revenue growth, positive cash flow, and proven business models. Your future self will thank you. Next up, we're going to talk about 3 cognitive biases that are costing you more money than even market crashes themselves. These mental traps are kind of sneaky. You don't even know you're falling into them. So mistake number 3 is confirmation bias. Once you own a stock, you kind of become like a detective, but you're only looking for good news. You'll read 10 articles about the company and remember only the positive ones, while forgetting all the rest and all the red flags. Charlie Munger, Warren Buffett's partner for 60 years, he really nailed it. He said, "What the human being is best at doing is interpreting all new information so that your prior conclusions remain intact." Your brain literally filters out all information that contradicts your investment decisions. So here's how I fix this bias in my own investing. Before buying any stock, I write down 3 reasons why it could fail. Then I set up Google alerts for negative news about the company. If I can't find credible criticism, I'm not looking hard enough. Most investors spend hours researching reasons to buy, but 0 reasons researching reasons to sell. This kind of creates a dangerous blind spot that I think can cost people a lot of money. I don't know if you remember the company Theranos, but they were touted as being a revolutionary health technology company. Investors ignored dozens of red flags because the story was so compelling. Scientists said the technology was impossible, but investors only heard about its potential. Confirmation bias cost them about $900 million. Theranos ceased operations in 2018. So the fix is actively seek some disconfirming evidence. Maybe join investment forums where people criticize your holdings. Read some short seller reports. And if you can't handle criticism about your stocks, you're not ready to own them. Coming up next, we're going to talk about the anchoring bias that keeps you stuck in losing positions, plus the overconfidence trap that can really derail even the most successful investors. So mistake number 4 is anchoring bias. It's being stuck on your purchase price. See, the market doesn't really care what you paid for the stock. It doesn't know that you own it. Here's the big reality check that will change your investing forever. The market doesn't care what you paid for your stock. Not even a little bit. If you bought Netflix at $400, the market doesn't care. If you bought GameStop at $300, the market doesn't care. A stock is worth exactly what someone else is going to pay for it today, not what you hope it'll be tomorrow. Yet 90% of investors treat their purchase price like it's carved in stone. Anything below feels like a loss. Anything above feels like a win. This is anchoring bias, and it keeps you in terrible investments. Warren Buffett put it simply. He said, "The price is what you pay, the value is what you get." Your purchase price isn't the stock's value. It's just a number from the past that really has 0 relevance on the future. So every quarter, I do what I call the fresh eyes test. I pretend I don't own any of my stocks, and I look at each holding like I'm seeing it for the first time. Then I ask, if I had this amount of cash today, would I buy this stock at the current price? If the answer is no, I sell it immediately. This simple exercise has saved myself and some of my clients millions of dollars by forcing them to evaluate investments based upon current reality, not past decisions. Your purchase price is a sunk cost. It's gone forever. The only question that matters is what the best use of this money is going forward. Holding on to a losing stock because you don't want to realize the loss is like staying in a bad relationship because you've already invested so much time. So the fix is every month, reevaluate your portfolio with fresh eyes. Ignore what you paid and focus on what each investment is worth today and where it's headed tomorrow. And now for the most dangerous bias of all, and that's overconfidence. This one destroyed my wealth early in my career. Well, whatever wealth I had early in my career. And I'm going to share with you exactly how it happened and why overconfidence cost me a fortune in future net worth. I just started in 1997 as a financial advisor, and in 1999, everyone seemed to be buying tech stocks, including myself. We were all having hot streaks. And I turned a $28,000 investment into almost $150,000 in about 6 months by buying tech stocks on margin. Then, in March of 2000, technology stocks started crumbling. And by the end of 2000, after about 12 margin calls, and margin calls are what happens when you're borrowing money against your portfolio to buy more stocks. You have to maintain a certain level of collateral or margin. You either have to come up with money or you have to sell stocks at losses to cover those margin calls. In the end, my almost $150,000 portfolio was worth less than $12,000. Overconfidence nearly ended my investing career before it even started. Thank God I got to learn this lesson when I was young. It all comes down to this. The more overconfident you become, the less likely you are to recognize it. And here's a fact that has always humbled me. 90% of active fund managers have underperformed the S&P 500 over the last 15 years. And these are professionals with teams of analysts, Bloomberg terminals, and decades of experience. If they can't beat the market consistently, what makes you think that you can? The most successful investors I know are the most humble. I'm a lot more humble today than when I was young and overconfident in my investing. So this leads me to wealth decision principle number 3. The market humbles the proud and rewards the patient. So if you're going to invest in individual stocks, try following the 80-20 rule. What you do is you use 80% of your portfolio to buy low-cost index funds in different parts of the market to have a diversified portfolio. And then use only 20% to go into individual stock picks, and only with money that you can potentially afford to lose. This approach has generated more consistent returns while protecting me from me and from my own overconfidence. So the fix is track every investment decision and calculate your actual returns versus a total market index or an S&P 500 index fund. Most investors are shocked by what they discover. Let the data hear your overconfidence. So you've learned a lot in this episode. So let's put this all into action. Let's start with a 3-step portfolio fix. Step 1, open your portfolio right now after this episode and identify any stock you wouldn't buy today at current prices and just sell it immediately. Step 2, set stop losses at 20% below the prices you paid for the individual stocks you own. No exceptions. And step 3, calculate what percentage of your portfolio is in unprofitable story stocks. If it's over 10%, start reducing some of these immediately. And this month, implement the quarterly fresh eyes test. Start maybe a decision journal for every buy and sell and automate investments into diversified ETFs. In this quarter, read a book like The Intelligent Investor or Random Walk Down Wall Street, and then calculate your actual returns if you're investing in individual stocks and how they've done against the total market index or the S&P 500. Remember Benjamin Graham's warning. The investor's chief problem and even his worst enemy is likely to be himself. So today, you've learned to recognize that enemy and set him aside. So let's recap the 3 wealth decision principles from today's episode. Number 1, winners keep winning and losers keep explaining. Number 2, invest in profits, not promises. And number 3, the market humbles the proud and rewards the patient. So thanks for tuning in to episode 61, 5 investing mistakes and how to fix them. And make sure you subscribe to my channel, hit the notification bell, or share it with a friend. My goal with the Wealth Decisions podcast is to reach over 100,000 people in the Twin Cities and beyond so that people can live a richer life. Thanks for listening, and go make a better wealth decision today.